Welcome back to Bazooka. Today is February 16th, 2026. The Nasdaq has been on a tear, hitting new highs. It feels like the party will never end. But quietly, something else is happening in the options market. Big money is buying protection, especially in tech. The put-to-call ratio for the QQQ, the ETF that tracks the Nasdaq 100, is elevated. That means a lot more bets on the downside than the upside. So here's the real question. Are the big institutions betting on a tech crash, or are they just acting like responsible adults after a long, profitable rally? Let's break it down calmly using the data. Right now, if we look at the numbers, the QQQ put-to-call ratio by volume is hovering around 1.42. For open interest, it's even higher, at about 1.71. In simple terms, for every 10 calls being held, there are roughly 17 puts. That's a clear defensive tilt. At the same time, the cost of that downside insurance, what we call options skew, is also high. But here's where it gets interesting. If we look at the individual mega-cap tech stocks, the story is different. For NVDA, the put-call ratio is around 0.69, Microsoft is at 0.46, Apple is at 0.73. Even Tesla, which is often a battleground, is near 1.0. Notice a pattern? The fear seems to be concentrated in the index, the QQQ, not across the board in the biggest individual stocks. This tells us something very important. This looks a lot more like broad portfolio hedging, not panicked selling of individual companies. And that's a massive difference. It suggests managers who are long tech want to protect their overall gains, not that they've lost faith in their favorite holdings. Now you might be wondering, is this unusual? Has this happened before? Yes, absolutely. This kind of setup often appears in strong bull markets. We can think of two different regimes for heavy put activity. Let's call the first one insurance after a big run. This is when the market has rallied strongly, investors have made a lot of money, and institutions decide to hedge their portfolios to lock in some of those gains. The cost of puts, or the skew, rises. But the market can continue to drift higher or just consolidate. This is rational, disciplined behavior. Then there's regime B, shock hedging. This is what you see during a real panic. Put buying spikes across the entire market, not just in one sector. Volatility explodes. Everything sells off together, and correlations go to 1. Right now, we are much closer to regime A. If we look at the broader CBOE equity put-call ratio, it's in normal territory, not panic mode. The translation? This doesn't look like the sky is falling. It looks like we've made a lot of money and now it's time to protect it. If Charlie Munger were here to analyze the situation, he might put it very simply. He'd probably say something like, when people start buying fire insurance, it doesn't mean they expect their house to burn down tomorrow. It just means the house has gotten very expensive. And that is exactly what's happening in the tech sector. The market ran hard and the value of these portfolios increased significantly. With that comes concentration risk. So what are institutions doing? They are managing their exposure. This is not a prediction of doom. It's simply prudent risk management. And this kind of risk management often appears during the mature stages of a rally. That doesn't mean it's the absolute end, but it's a clear signal that we're no longer in the early innings. The easy money has likely been made, and now the focus shifts from pure growth to capital preservation. So let's get practical. What should a regular investor consider doing in this environment? First, let's talk about what makes sense. It's a good time to rebalance. If your allocation to tech or the QQQ has ballooned and is now way oversized compared to your original plan, it might be wise to trim it back to your target weight. Second, focus on quality. Favor businesses with strong, consistent cash flow that can weather a 20 or 30% market correction without their fundamental story changing. Third, if you're buying, consider scaling in incrementally rather than going all in at once. And fourth, reduce leverage. This is not the time to be making heroic bets with borrowed money. Now, what should you avoid? Don't chase stocks that have already gone vertical. Avoid buying companies trading at peak multiples that are priced for perfection. And most importantly, don't start shorting the market just because you see a high put-to-call ratio. Remember, hedging is defensive, not necessarily predictive. Assuming that a high number of puts automatically means a crash is a common mistake. So where is the real opportunity here? When downside insurance gets this expensive, it tells us two things. 1. The crowd is already leaning defensive. A lot of the fear is already baked in. And 2, some of the potential future downside might already be pre-priced by the options market. Now, this doesn't guarantee the market will go up, but it strongly suggests that the market is no longer euphoric. The wild optimism has cooled. And if we go back to Munger, he always preferred investing when enthusiasm had faded, when expectations were more reasonable, and when allocating capital required careful thought, not just adrenaline. This is that kind of environment. It's a time for thinking, not for chasing momentum. The opportunity is in being rational when others are simply reacting to the price action of the last 12 months. To wrap it all up, the heavy hedging we're seeing in the QQQ today tells us that institutions are being cautious. But crucially, they are not fleeing the market. This feels like a late rally discipline phase, not a pre-crash panic. As Munger might have said, you don't need to be able to predict the storm. You just need to build a boat that floats. For investors, this means it's time to check your own portfolio, rebalance your positions, reduce the fragility in your holdings. Focus on owning durable, high-quality businesses for the long term. Ignore the day-to-day noise and let the power of compounding do the heavy lifting for you. Thank you for watching. Remember to like and subscribe for more content like this. And as always, this is for educational purposes only and is not financial advice.